When buying a car, many prefer to buy new in order to have peace of mind and to know the vehicle comes with a full warranty.
The engine and the transmission are the most expensive parts of a car to repair.
I'm about to show you how dealerships got 39% of car owners to owe more money than their car is worth. And if you financed a car in the last 3 years, there's almost a 50-50 chance you're one of them. The average person trapped right now is $6,458 underwater. Some people owe $15,000 more than their car is worth. And here's the thing. They have no idea how it happened. Because it all started with one question. What monthly payment works for you? Stay with me for the next 10 minutes because I'm going to show you exactly how this question costs people thousands of dollars. And more importantly, how to make sure it never happens to you. The setup. Let's say you walk into a dealership, you've done your research, you know the car you want, you know it's worth $40,000, you're ready. The salesperson is friendly. They bring you to their desk. And before you even talk about the car, they pull out a calculator and ask, just so I know we're looking at the right vehicles, what monthly payment are you comfortable with? Seems reasonable, right? They're trying to help you stay in budget. Here's what just happened. You went from negotiating the price of a $40,000 car to negotiating how to arrange a payment plan. And that shift from price to payment just gave the dealership complete control because now they're not trying to get you to agree to $40,000. They're trying to get you to agree to $600 a month. And they can get you to $600 a month 100 different ways. They can extend your loan from 60 months to 72 months. They can bump it to 84 months. They can adjust your interest rate. They can play with your down payment. They can add gap insurance, extended warranties, paint protection, whatever it takes to keep you at $600. And you'll feel good about it because you got your $600 payment. But here's what you didn't see. The math reveal. Let me show you the actual math on that $40,000 car at 7% interest. If you finance it for 48 months, your payment is $957 a month. Total cost is $45,936. If you stretch it to 60 months, your payment drops to $792 a month. Total cost is $47,520. Go out to 72 months, you're at $683 a month. Total cost, $49,176. And if you go full 84 months, which is 7 years, you're down to $602 a month. Total cost, $50,568. Let me say that again. Same car, same purchase price. But by stretching the loan from 48 months to 84 months, you save $355 on your monthly payment and you pay $4,632 more for the car. That's not a financing fee or taxes. That's just interest. Extra money you're paying for the privilege of smaller monthly payments. And here's the thing. $355 a month feels massive. That's a car payment, grocery money, or simply real savings in your monthly budget. The $4,632, that's an abstract number on a piece of paper you're signing, while the salesperson is explaining gap insurance, and you're just trying to get to the part where you drive the car home. Now you might be thinking, okay, but if I can actually afford the $602 payment and the longer term gives me breathing room, maybe that's worth $4,600. Fair, but we're not done yet, because the monthly payment is just the first trap, the depreciation bomb. Here's what happens to your $40,000 car the moment you drive it off the lot. It loses about 20% of its value immediately. You now own a $32,000 car. After year 2, it's worth about $27,000. Year 3, around $22,000. By year 5, you're looking at $16,000 to $18,000, depending on the vehicle. Now let's map that against your 84-month loan. After 12 months of payments, you've paid down about $4,800 in principal. You owe roughly $35,200. Your car is worth $32,000. You're already underwater by $3,200. After 24 months, you owe about $30,400. Your car is worth $27,000. You're still $3,400 underwater. After 36 months, you owe $25,500. Your car is worth $22,000, still underwater. $3,500. You don't reach positive equity, where the car is worth more than you owe, until around month 60, 5 years in. And that's assuming everything goes perfectly. No accidents, no major repairs. The market doesn't shift. You keep making every payment on time. So for 5 full years of your 7-year loan, you're trapped. You can't sell the car without writing a check. You can't trade it in without rolling negative equity into your next loan. And if something happens, you lose your job, you need a different vehicle, the transmission dies, you're stuck paying for a car you can't afford to keep and can't afford to get rid of. The death spiral. Now here's where it gets really bad. Now let's say you're 3 years into that loan. You owe $25,500 on a car worth $22,000, and you need something bigger, new kid, new job, with a longer commute, whatever. You go back to the dealership, you pick out a $45,000 SUV. Great. But you can't trade in your old car without dealing with that $3,500 in negative equity. The dealer has a solution. We'll just roll it into your new loan. So now you're financing $48,500 for a $45,000 car before taxes, fees, gap insurance, and everything else they're about to add. Your new loan, $55,000, 84 months, 8% interest because rates went up. Your payment is $839 a month, and the cycle starts over. Except this time, you're starting $10,000 underwater instead of $3,500. This is happening right now to millions of people. In Q4 of 2024, 44% of people who bought cars since 2022 are underwater. The average negative equity hit a record, $6,458. And for people trading in with negative equity, they're adding an average of $12,388 to their next loan, plus an extra $159 a month in payments. This is the death spiral. And it all started with, what monthly payment works for you? The psychology. So why do we fall for this? Because we think in monthly terms. Rent is monthly, utilities are monthly, subscriptions are monthly. Our entire budget is structured monthly. When a dealer says, I can get you to $600 a month, your brain files that next to your phone bill and your gym membership. It feels manageable. When they say, this car costs $50,568, your brain short circuits. That's not a number you work with. That's abstract. That's someone else's problem. Here's the other thing. Dealerships train their salespeople on this. They know that if they can get you focused on the monthly payment, you'll stop looking at everything else. They know you're tired by the time you get to financing. You've been there for 3 hours. You've test driven the car. You've picked the color. You've negotiated the price, or you think you have. You just want to sign and leave. And when they finally get you to your target payment, it feels like a win. I told them I needed to be at $500, and they made it happen. You feel good. What you don't realize is they made it happen by stretching your 60-month loan to 84 months and bumping your rate from 6% to 7.5%. You just agreed to pay $8,000 more for the same car, but it feels like they did you a favor. The solution. All right, so how do you beat this? First, never answer the payment question. When they ask what monthly payment works for you, say this. I need to see the total cost first. Show me the out-the-door price, then we'll talk about structuring the loan. This immediately shifts the conversation back to price, and it signals that you know what's happening. Second, the 60-month rule. Never finance a car for longer than 60 months. I don't care how good the payment looks. If you can't afford the payment on a 60-month loan, you can't afford the car. Why 60 months? Because that's the break-even point with depreciation for most vehicles. Past 60 months, you're spending years underwater and paying thousands in extra interest. Third, 10% down minimum. If you can't put 10% down, you're not ready to buy. That down payment is your buffer against immediate negative equity. Without it, you're starting underwater. Fourth, pre-approve your loan before you go to the dealership. Walk in with a 5.5% approval for 60 months in your pocket. When the dealer offers you 7% at 72 months, You say, I'm already approved at 5.5% for 60. Can you beat that? If they can, great. If not, you use your pre-approval. This eliminates the payment game completely. You already know what you qualify for. You already know your budget. They can't manipulate the terms because you've locked them in. And fifth, the total cost rule. Before you sign anything, make them show you the total amount paid line. That's your monthly payment times your loan term. That's the real number. If it's not less than 15% of your annual gross income over the life of the loan, walk away. Example, you make $60,000 a year. 15% is $9,000 annually. Over 5 years, that's $45,000 total. If your car loan totals more than $45,000, you can't afford it. This keeps you from getting stretched too thin, because the monthly payment might work now. But 3 years from now, when you need new tires, new brakes, and a transmission service, that monthly payment becomes a financial nightmare. The reality check. Look, I'm not saying dealers are evil. Most salespeople are just doing their job. They have quotas, they have managers breathing down their necks. They're working within a system that rewards them for maximizing financing profit. But that system is not designed with your financial health in mind. It's designed to get you into a car today, even if that car is going to cause you stress for the next 7 years. Right now, 39% of car owners owe more than their car is worth. That's 1 in 3 people, and the number keeps going up. The average car loan term is now 69 months, up from 48 months just 20 years ago. We're normalizing longer and longer debt for depreciating assets. And the consequence is millions of people trapped in cars they can't afford to keep and can't afford to get rid of. You don't have to be one of them. Now, you know the trick, you know the question, you know the math, and you know how to protect yourself. The most expensive car you'll ever buy is the one you can't afford, no matter how manageable the monthly payment looks. If you found this helpful, share it with someone who's about to buy a car. Drop a comment with the longest loan term you've ever seen, and I'll see you in the next one.